Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage. He was identifying winning stocks with massive uptrends, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,000%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where a stock is most likely to go next in any type of market. Simply go to chaikintrial.com for your free look. Again, that's chaikintrial.com.
Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is the 10th of March. It is a Thursday. And what a wild week we've had so far. Yesterday, the best day that we've seen the S&P since June 2020, but down again this morning on, of course, what's going on in Ukraine right now. Peace talks not going too well. Oil back up after a big drop yesterday. We're going to talk about that. We're going to talk about what Joe Biden came out with an executive order about cryptocurrencies, how it's affecting Bitcoin. Again, wild move. CPI, we have inflation. We have the ECB, the European Central Bank, coming out. What's going on with the Fed? Are they going to raise interest rates in the next couple days? We'll figure all this out and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It is the 10th of March. It is a Thursday. And there's a lot going on. I mean, what a day yesterday. We had the S&P yesterday have its best one-day rally since June of 2020. So that's, nearly 2 years looking out, a few months short of it. So that was a big move. We're down again this morning. The big move yesterday was on really hopes that we would have some type of peace, a resolution, let's say, in the Russia-Ukraine conflict. That, of course, has not happened. We saw oil prices drop huge yesterday, the biggest drop that we've seen in months. Based on obviously the fact that if something good comes out of Ukraine, we will see commodity prices, aka oil, fall as maybe some supply comes back online. There were some rumors yesterday, and not only the rumors, I guess talks, you could say, that the U.S. is going to be reaching out to Iran and Venezuela to get some more oil online, which I find fascinating because, my God, talk about bringing some more bad actors into this entire scenario. It's crazy to me. So I don't know where that ends up going. That being said, oil is going to continue to be driven by the headlines, driven by news. We'll talk about the price of oil here in a minute. But what I want to get into here is I'll talk about the markets a little bit. Let's pull up the chart here of the S&P 500 right now. As you can see, we're about 35, 40 minutes into the session here on Thursday morning, and we have the S&P down about 0.8% off the lows of the day. And you can see it's tough to see, but there was obviously a big day update yesterday because we closed way down here, then we rallied back up, and then we're pulling back a little bit today. But overall, the market's just in this up and down swing right now. We're 2 days from the lowest close that we've had since going back to June of last year. Still in a short-term downtrend. So again, I don't think you run out and try to pick a bottom here, but at the same time, I think we are close to a situation where it's that sweet spot, if you will, where the markets are close to a near-term bottom. And there was a statistic that I read from Ryan Dietrich from LPL Financial, who I had on the show last year in my old podcast. Great guy. But he came out and put out these numbers that I'm going to try and find them here for you real quick, that typically you're going to see in the midterm election year, which that's what this year is right now. We see the markets, the drawdown, the top to the bottom. I believe it is around 17% or so. I'm going to pull up the numbers for you right now. Around 17%. In that time frame, it feels hard and it feels really, really tough when that happens. Yeah, the average is 17.1% is the intra-year pullback. This happens every 4 years. So obviously it happened 2018. Market was down 19.8%, 2014, 7.4%, 2020, 16%. But what's fascinating, going all the way back to 1950, so over 70 years, the return 1 year later from that bottom And right now, the S&P is down about 12% or so. 1 year later, since 1950, every single time the S&P has been up 1 year later from that low, that intra-year low of the midterm, which we're in right now, every single time since 1950, the average gain, 32.3%. 32.3%. What happened in 2018 was the last time we had a midterm election year. 1 year later, 37.1. The worst was in 2014, 1 year later, up 8.7%. But keep in mind, we only pulled back 7.4% that year, so we didn't pull back as much. This is a fascinating statistic that a lot of people aren't talking about. Midterm election years are a bit wild because typically in a first term of a president too, you're going to see a lot of shift. Democrat wins, usually Republicans take some of the House, which we'll probably see this year. But again, the stock market, it's fascinating to me, the statistic that a lot of people aren't talking about this right now. But it's something that I think we need to be cognizant of that. I don't know if this is the bottom, but even if we pull back on our 5% or so, if we're on the average from that low up over 30%, about 32%, much higher from where we are today. So again, I want you to keep that statistic in mind when you get freaked out and worried about the market, that there are some good things out there right now as well. So as I mentioned, S&P down about 0.8%. Let's take a look at the NASDAQ, because obviously the NASDAQ is a little more tech heavy, a little more volatile, near the high today right now, but it's down about 1.4%. So it is down a little bit as well with the S&P 500. Let's take a look at the oil ETF, which is USO, and look at some of the volatility that we've had in that. You can go back to Tuesday when we rallied up to about $87, $88. Then we fell all the way down to the low 70s. We're down again today. We're at 74.39. Oil's around 110, 111 a barrel right now. So we've had some pullback in oil, and people say, where's it going to go next? Is it going to go to 200? Is it going to go back down to 70? I get that. Tell you, in near term, it's all headline driven, folks. I don't have a crystal ball. I did say on Tuesday on all these commodities that if I had some, I'd be taking some profits and I would not be buying. And so far, I don't want to say pat myself on the back, but in 2 days we've had quite the pullback, and it felt so frothy. And again, I don't have a crystal ball, but it felt bubbly, as I like to say. And we saw that in a lot of things. We saw that in nickel. We saw it in oil. Let's take a look at the nickel fund here that I've showed you last week, and look at the volatility. Again, look at this. On Monday, above $70 a share. Now it's down to 44 and change. I mean, this type of action that we see in this JJN, which tracks the price of nickel. I mean, this is stuff that if it was Bitcoin or any other cryptocurrency, all the guys on Wall Street would be saying, oh my God, look at this. This is too volatile. It's crazy. But then they don't say that because it's a commodity. But this is nuts. This action is absolutely crazy, folks. And I showed you some individual stocks last time as well. I'm trying to remember what one of them was and see what they've done since then. HUSA was one of them, Houston American Energy. Again, look at this on Tuesday. And Tuesday was above $16. It's down to $8.20. It's down literally 50% in those 2 days since I said, no, you don't want to be buying here. Again, this is what you call a bubble. This is just nuts to me. So keep that in mind, please, that these types of days, don't chase that performance. Don't chase that hot stock. It doesn't end well. It just never does. Just like the meme stocks, it just doesn't end well. Well, speaking of volatility, let's talk about Bitcoin and cryptocurrencies here. Biden came out this week with an executive order and on cryptocurrencies, and the basis of it was that the government's going to be a little more involved in it, and I am anti-government involvement in 99% of things. I wouldn't call myself a libertarian, but I think the people could figure it out. We don't need the government sticking their hands in everything because they tend not to do very well. I mean, have you been to the DMV or the post office lately? They're not good at running businesses or doing things. So I tend to like to have them stay clear and let us figure it out. That being said, cryptocurrencies are still the wild, wild west, in my opinion. And we've moved along, and the adoption has been so much better than I thought, market cap in the trillions. So we're moving in the right direction. That being said, a little bit of framework, a little bit of, I hate to even use the word regulation, but a little bit of regulation framework will help that and take it from the wild, wild west to the wild west. I want to keep it wild, but not that wild. And so I think what's going on here is um, it was good news because we saw Bitcoin go from 37,000 to 42,000 overnight. We're back down to 38,000 now as people start to digest it and worry about maybe too much overreach from the government. I don't know where this ends because it's kind of vague. The executive order, as most things coming out of the White House these days, are vague. So you can play both sides of the aisle. So I don't know where it ends, but obviously the market again, it's a little bit uncertainty weighing on cryptocurrencies. So I'm not quite sure where this executive order lands. But again, around 38,000, I love Bitcoin down here. It could fall to 30 before it goes to 60, but I still think we're back in the 60s before you know it. So I think there's still some great opportunity in Bitcoin and other cryptocurrencies at this time. So this morning we had our inflation number come out. The CPI, Consumer Price Index, came in at 7.9%. That is a 40-year high since 1982. I mean, I was a mere 6 years old at the time. That's pretty crazy. The core, which is inflation, X energy, and X food, which that's a lot of things that we pay for outside of our house and our car. X energy, X food came in at 6.4%, also the highest since 1982. I think it was August 82 was the time that we were higher than 6.4%. So within that number, though, there was some interesting things to see. Believe it or not, you look at the the car numbers actually pulled back a little bit. Some of the used car prices actually came down month over month, which we haven't seen that in a while. But still, year over year, we see the housing number or the used cars up 42% year over year. It's nuts. But I think the prices are so high that people are actually starting to take a step back from it. So we're seeing a little bit of that come down. But obviously, oil with what it's been doing with the Russia situation, food prices continue to go up. So I don't see inflation due to the conflict over in Ukraine coming down anytime soon. Do I see it spiking much higher? I don't, and maybe I'm being a bit Pollyanna there, but I don't see it spiking much higher from here. That being said, obviously I'm going to keep a close eye on it, and I have some investments in my own portfolio that are hedges against inflation. That some exposure to commodities, exposure to food and fertilizers. I think there's a lot of opportunity there. I talked about these fertilizer stocks. I think maybe last week. How well they've been doing. I haven't checked them in a couple of days, but let me pull one up here for you. I'll take a look. This is Nutrient, NTR. You can see, it's still doing well. I mean, it looks like on Monday it hit a new high. Then we pull back a little bit the last 2 days, but again, up at 3% today. And this stock is up over 100% in the last year. So they continue to do well. And these are ways, again, this is a bit frothy. I wouldn't necessarily run out and buy this here. And again, nothing here is a buy or sell recommendation ever. But keep that in mind. I'm not saying run out and buy these, but these stocks continue to do well. And they have been a very nice hedge for the overall market. I talked about last Tuesday that the European Central Bank was also meeting overnight. So they came out and they kept their interest rates steady because obviously what's going on right now in Ukraine. But they unexpectedly, they did announce that they're going to start winding down their asset purchase program a little bit quicker than but the analysts had anticipated, again, due to potentially inflation continue to rise in 2022. So they did say that. So European markets were down on that, and they also were down on just a fact of what's going on in Ukraine. So heading into the CPI number this morning, there was a 70% chance that we're going to have 25 basis point rate hikes this year. So that's 0.25%, which means you add that together, that's 1.5%. Interest rates right now are a range of 0 to 0.25. So basically take us to 1.5% is where it would take it. Again, still extremely low in a Fed funds rate. And like I said, it's about a 70% chance heading into today's inflation number. And I don't think it's changed much because the inflation number 7.9% was right in line with expectations. So I don't think we're going to see much more from that. And then the meeting is March 15th and 16th. So the decision comes out on the 16th. Today is what? The 10th. So it's going to be next Wednesday, folks. So next Wednesday. So a Tuesday show, we'll talk about that heading into it, what my expectations are. I think as of right now, unless something dramatically changes, we'll have a 25 basis point, 0.25% interest rate hike come out of the Fed next week. So, but we'll talk about that as we get closer. And of course, when we talk about the Fed, we have to talk about the 10-year yield. The yield on a 10-year, pulling up for you right now, is back above 2%. It was above 2%. The whole stuff happened over in Ukraine. We pulled back below 1.7% actually for a moment. And you can see in a chart here, bouncing back 4 days in a row, back to the 2%. And that's a reason we're seeing stocks pull back as well. But it's kind of fascinating because, again, for interest rates to go up, it means that bond prices are falling. And we can take a look here. This is a TLT. This is the iShares 20 plus year Treasury bond ETF. So basically what this is, it invests in long bonds and 20 at least 20 plus years out. You're seeing here, this is actually down 1.8%. And I've brought this up before, but I think it's always important to talk about this. A lot of people believe in this time that we have right now that they're concerned about the stock market, that they should be overweight bonds, going into bonds, buy fixed income. And a lot of advisors out there, and there's a lot of bad financial advisors out there, will tell you the same thing. What they forget or don't know is that, again, I talk about this all the time, as interest rates go up, prices of bonds go down. That means the value of this ETF will go down. This ETF began the year about $148. It's $134 right now. So we're down $14. So just under 10%. We'll call it 10%. It's down about 10% in 2.5 months, folks. 10%. The yield on this is only 2 and change, a little over 2%. So it's not like the yield's going to save you. And as interest rates keep going up, this will continue to fall. So please keep that in mind, that these bond funds and these bond ETFs aren't necessarily safe. I mean, there's risks in everything, but these aren't necessarily safe, especially in this type of environment. I'm going to say this over and over because I feel it's extremely important that the average investor knows this, because most do not understand that. All right, so what I want to talk about next, I'm going to do 3 things. I'm going to talk about Amazon stock. They announced a 24-1 stock split. I want to talk about 2 stocks that have very little sales outside the US, which if you want some type of hedge of what's going on right now. And then I just mentioned interest rates up to 2% in a 10-year. We're going to talk about some regional banks and once I show you the chart, you're going to know why. But first, let's jump into Amazon. Let's take a look at Amazon here today. We'll pull up the chart. As you can see, the stock is up about 6%, $163 a share to $29.49. We'll call it $29.50. And it was just at a 1-year low 2 days ago on Tuesday, and a big bounce back from there. As I mentioned, it amounts to 20-for-1 stock split, which you do the math there, it's going to be about $100 and some a share. And then they also announced they're doing a $10 billion stock buyback, which is obviously helps the earnings per share of Amazon. So that's got it moving. And I got to tell you, whether we have inflation or interest rates, Amazon's not going anywhere. Their AWS, obviously their flagship online, their Prime. I mean, this is a solid company. So I still look at Amazon and I think, wow, this is solid here. But I take a look at the size. It's still, it's a huge company. Its numbers are impressive. It's about a $1.5 trillion company. And if I take a look at the estimates going forward, earnings per share this year is estimated to be around $49, then $73 in 2023, $115 in 2024. So it's trading with a forward P ratio of just under 40, forward price of sales of 2.3, and a PEG ratio, which is a price earnings divided by its growth estimates, of 0.82. So as much as it's been up, it's actually, I don't want to say it's cheap here, but it's not expensive in my mind, honestly. When I look at this, it's just really not that expensive. And if you take a look at the forward PE ratio, it's pretty low. I mean, historically speaking, it's really low. So I actually really like Amazon down here, especially with if the stock split too. There's some chatter out there that the stock split, because now it's at a more reasonable price per share, can eventually put it into the Dow Jones, and that I can see. I mean, it is one of the more important companies in the world, for sure, one of the biggest companies in the world. So I think we could see that. So I think that's a pretty fascinating way to look at it. But boy, Amazon looks pretty good down here. So now I want to take a look at 2 companies that have very little sales in the U.S. A lot of people say, well, how do I protect myself against what's going on? Well, one of them is Constellation Brands, symbol STZ. They only get about 3% of their sales outside the borders of the United States. So basically, it's U.S.-centric company for being a bigger company. There's a lot of small companies that only get sales here, but this is a bigger company. And it's known for its beer, its wine, its booze, it's marijuana. It owns part of Canopy Growth, one of the largest cannabis companies in Canada. So it has exposure to its vices. There's a lot of vices. You can see here on the chart, after breaking out, it's pulled back and it's got this big double bottom here around 205 to 210. We're at 212 today. So it's not a bad area to start taking a look at the stock. And again, this is the type of stock that regardless of what happens in the world, people aren't going to stop drinking, and I guess if you smoke marijuana or eat marijuana, edibles probably won't stop doing that. It's known really for its Corona and Modelo brands. It also has some smaller ones. It has wine, craft beer. It owns nearly 38.6% of Canopy Growth, as I mentioned, which is cannabis. It's a $39.8 billion company and pays about a 1.4% dividend. Forward PE ratio 16, forward price of sales 3.9. So, again, not cheap, but not expensive, in my opinion as well. The other company I want to talk about, and you rarely hear me talk about the companies like this, but it's symbol T, AT&T. And again, I wouldn't say I'd go buy this, but if people are looking for that exposure, only 9% of its sales are outside the borders of the U.S. I don't like AT&T down here, but I was just trying to find companies to give you an idea of what is out there. But the nice thing about AT&T, and the reason a lot of people buy it, is based on its dividend. It's an 8.9% dividend yield, which is huge, especially considering the 10 years only at 2%. It is a $165 billion company, so it is obviously a large company. We all know AT&T, through cell phone service, etc. Forward PE ratio is only 7.1. Forward price of sales is only 1. So it's cheap as far as that's concerned. What I don't like is earnings per share in last year in 2021 came in at $3.40 a share. This year, the estimate's $3.13. Next year, $3.24. 2024, $3.20. No growth on the bottom line. No growth at all. Revenue came in last year, $168 billion. This year, estimate 156. Next year, 159. Next year, 164. No growth there. So again, but I wanted to share this with you because I think it's important to just share ideas, just to show you an idea of really what type of companies are here that are getting sales from here. So the last segment I want to talk about here is KRE and regional banks. KRE is the S&P regional bank ETF, and it's actually up today, 0.24%. The reason I'm bringing up financials and more specifically regional banks is the exposure to interest rates. As interest rates go up, the margins that regional banks and all banks that lend money have on that increases. As the margin increases, the bottom line increases, which means it's more profitable. So I foresee interest rates continue to go up. I'm not saying spiking, but move up over the next couple of years. It should be very good for the banking industry. The reason I picked the regionals is because they have a little bit more exposure to the interest rates. Also, they do not have exposure, most of them do not have exposure to what's going on in Russia, Ukraine right now, where some of the bigger firms like JP Morgan, et cetera, do have exposure to Russia, obviously, because they're global companies. So you don't have exposure to that, if any, maybe a little bit, but probably not much at all from the regional banks. So as you can see there, KRE, quite the great looking chart. So I got 3 stocks here that I like. First one is People's United Financial, PBCT, Paul Boy, Charlie Tango. Again, look at this great chart. Just off a high, consolidating up 0.75% today. This is a company that's about $8.7 billion based in Connecticut. It's got branches in the Northeast, Connecticut, New York, Massachusetts, Maine, Vermont, New Hampshire. Has a 3.6% dividend, so a nice little bit of income coming in. Again, with a 10-year at 2%. P ratio 15, price of sales 4.3. Again, not cheap, not expensive. Great looking chart, as you can see here. So I think it's one you want to throw on your watch list. The next one is SBNY, and I've talked about this one in the past. This is Signature Bank. It's based out of New York. What I like about Signature Bank is they have some exposure to cryptocurrency. So it's kind of a backdoor way into playing some cryptocurrencies. $19 billion market cap, a little bit smaller dividend, only 0.7%. PE ratio 12, price of sales 5.4. So again, not cheap, not expensive, nice looking chart. So it's one, again, to put on a watch list, and with the exposure to cryptos, I really like that as well. And the third one is one that I recommended many, many years ago. It's a stock that I've watched for a long time. This is SVB Financial Group, symbol SIVB. SI, basically Silicon Valley Bank, is SVB, Silicon Valley. So that's where it's based, out in Silicon Valley. So it has a lot of exposure to what's going on out there, to the tech companies and startups, etc. It's a company that I really like, 'cause I don't see Silicon Valley going anywhere at this point. Doesn't pay a dividend. It's more of a growth play. $31.3 billion company. PE ratio just under 13. Price of sales 3.8. So again, kind of falling in line with all the others. It has pulled back about $210 or so from its high. So it's got a pretty big pullback, almost 30% or so. It looks pretty damn good down here, honestly. I like the pullback that we're seeing in Silicon Valley Bank. So I hope you liked today's show, because I just kind of went through a lot of different topics. I want to always touch on what's going on in the headlines. We kind of have to do that in this day and age because the market's moving so much. But I also always want to give you some ideas and some education along the way. Remember, there's three things that I really want to focus on when it comes to this. It's education, it's having fun, and of course, making money. And that's the name of the show. Before we wrap it up here, take a look at the S&P 500, down about 1% right now, closer to the lows of the day. By the time the market wraps today and through the weekend, we could be anywhere, honestly. It all depends what's going on over in Eastern Europe right now. So prayers with everybody over there, anybody affected by it, coming from myself and my team. Stay safe. Have a great weekend, folks. Enjoy it and be grateful. And thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.